Today I want to talk about precision. We all know that lower time frames can be messy, there is a lot of noise, and how do I filter that noise? I use specific setup on my charts. It's simple, it's visual, and it helps me find better entries and safer places for my stop loss or hedge. Idea is simple here. If I switch to higher time frames, I have different pivot points. For example, on 4-hour time frame I have my weekly pivot points, on 1 hour I have daily, and so on. On 15, 4 hour, 5 minutes, 1 hour pivot points. And if I switch to 1 minute time frame, which I use to scalp during a day, I have a little bit different setup than on higher time frames. So you can see that instead of this standard Bollinger Bands, I have two Bollinger Bands and Ichimoku Cloud. First, let's set up the chart, and later we will talk how you can use it in practice. As you can see, I use two sets of Bollinger Bands and Ichimoku Cloud. The first set is Bollinger Bands 50 with deviation 1, and the second set is Bollinger Bands also 50, but deviation is 188. There it is. We have two Bollinger Bands, and when it comes to Ichimoku, we have standard Ichimoku with these parameters, and you can select Tenkan to none, Kiyun none, Chikou none. So you are left with up Kumo and down Kumo, and you can make it bolder. That way you will have something similar that is on my chart, that you can see on my chart. The logic here is simple. Bollinger Bands adapt to volatility. They expand when market moves fast and contract when it's quiet. This is a good example over here. When market is quiet, Bollinger Bands are closer to each other. When market is moving faster, Bollinger Bands are getting wider. Okay, so let's check how it works in practice. But first, let me clarify that one thing, that the way I trade on lower time frames when I scalp, it doesn't mean necessarily that this is one and only way or the best way to use this approach. I wanted to show you that you can use mechanical approach where you have bands, where you have cloud, and you have something visual that you can use to decide when you want to open a trade, to decide where to place stop loss or hedge, and so on. That's the reason why I like this approach, and I will give you a few examples how you can open and protect your trades with this kind of setups. My trading plan is usually simple. I check higher time frames, decide about trade direction, and wait for signal on lower time frames. Let's say that in my case I waited for short entry. Short entry meaning that price went above band and closed below it. So this was my short entry. In that case, my stop loss or hedge will be on the opposite band to that when I opened a trade. That means the first opposite band is that one, or it can be the second one, depends from price action, volatility during that day, during specific hours of the day. Thanks to that, I have some room. So even if there will be some range movement, maybe price will try to move higher, I still have some room before my stop loss or hedge is hit. As you can see, I'm using combination of Bollinger Bands and Ichimoku Cloud. Reason is simple. I wait for situation when price is on the same side as my trade direction. If I'm waiting for short opportunity, I wait for situation when price is below Kumo, below cloud. If I wait for long opportunity, I wait for situation like here that price is above cloud. Sometimes you will get mixed signals. That means that price might be inside the cloud. In that case, I will wait for a confirmation from the price. And yeah, this is a good example of that situation. Price tried to move higher, went above the cloud. We wait for short opportunity. In that means that we waited for price to move below cloud. In the same time, price crossed the middle line. This was a good short entry, short opportunity. Later, we had situation that price tried to move higher, but it was still inside the cloud. You may see that it broke through bands, but that took place inside the cloud. In these cases, I would prefer to wait for correction and another signal when I'm in the clear, that meaning that price is above the cloud and there is cross with the band. I also want to give you a tip about using second bands. Second bands meaning band up here and band on the lower side. If you are getting stopped a lot, it's a good idea to consider them as your stop loss or hedge placement, because when you use them, they will give you a little more room for price to play out. Check this example. Let's say that we went short over here, or maybe even over here, and our stop loss or hedge is on the band here. So we are waiting for price to move down, and you can see that there was this was between sessions, okay, but you get the picture. There was some range movement, eventually price moved down, correction up, and this is what, like 7 p.m, this is like 8 a.m, and during all these hours this level would not be hit, and it was hit over here when there was a change in the trend direction. But this is a good example, a good representation how this second band can give you some room between entry and your stop loss. You are not stopped out so often. And again, when we go back to this moment over here, let's say that you waited for long opportunity, you went with long after cross with 50, which I sometimes do, but when I go with 50, I always go with second band as my stop loss or hedge level. I do not go with the first one because first one is too close to my entry point. You can see that, let's say that this was our entry, and we are only a few pips away from the first band, but when we consider second band, it gives us little more room, and that's what we want, that's what we need. And okay, maybe that long entry was too early, there was some movement down, but eventually price went up and we would not be stopped out because our stop loss or hedge was around here. Okay, one more example. Let's say that market is volatile, price is moving fast, we are dealing with a stronger trend, and you are afraid to open a trade because you're thinking, okay, trend is so strong, it might reverse and I will be stopped out. With that approach, it's easier to manage your trade. Let's say that you saw this situation over here, price is below cloud, and you know that you wait for short opportunity, you went short here or here, both good entries, and your stop loss or your hedge will be at least here, or as I said, even sometimes on the second band. That means that you are like, what, 2 pips, 4 pips away from this place. But on the other hand, you can see that if you waited this out, this was a stronger move down. With that approach, you still have a good risk-reward ratio. And of course, in markets like this, it's important to close your losses pretty fast because, again, market might reverse in a moment and you might see a stronger move up, which will give you much bigger losses. But with this approach, it's much easier to manage your trade, manage your risk-reward ratio, and open a trade even during fast-moving periods. This is it. I hope that you liked this idea. As I said, it's not the only way you can use this. You can play with other parameters, you can play with other tools. Main idea here is to build something mechanical which will give you good entry points and which will help you to still manage your risk-reward ratio.